Mike, April showers bring May flowers is the saying. And we're going to talk about the month of May in the markets here today. Let's start with a recap of what May brought us and what we can expect going forward after that.
Yeah, there's also the saying, sell in May, go away. That certainly wouldn't have worked this time around. The rally in U.S. equities continued during May. S&P 500 up somewhere near 4%, up about 35% from the market bottom on March 23rd. And now the S&P is at levels we haven't seen since early March, when we were just sort of in the very beginning of the COVID-19 crisis here in the U.S.
So we saw a lot of trends under the surface in May, particularly sort of the start of what we call a rotation, the growth to value rotation, or as we talked in earlier videos, the haves to have-nots rotation. So give us some perspective on what went on under the surface.
The biggest move we saw was the last couple weeks of the month. The have-nots companies, the have-nots index we created was up over 20%, outperforming the haves by about that same margin. The haves basically went nowhere. And a lot of that was fueled by positive news on the vaccine front. And the basic idea was, as the shutdown continues, the haves companies, the large growth companies where their business models may have benefited from this shutdown in many ways, those companies just continued to get bid up. But as we get more and more positive news about reopening, we're now at the point where all 50 states have reopened or have plans to reopening, and you combine that with some exciting, maybe premature news on the vaccine front, that those have-nots companies can start to get bid up. And that's really the first sign we've seen of that. So we definitely saw a rotation start the last 2 weeks of the month. And we also saw the value growth trend start to reverse. Growth stocks have been outperforming value stocks by the largest margins since the tech bubble in the early 2000s. And we finally saw in those last 2 weeks of May, value stocks outperform growth by almost 5%. So making up some ground pretty quickly.
And in May, we saw a lot of ugly numbers. The jobs numbers continue to get worse, and that really doesn't trend with a market being up. So maybe give us some perspective on sort of what's happening with the reopening and how the numbers on the economic side compare to the market side.
On the economic side, you could characterize it as decreasingly terrible, I guess is what you would say. And that's really what the market focuses on. They're more focused on the direction, not necessarily the level. So a couple encouraging signs we saw. One was on the job front. Obviously, the job situation is absolutely unprecedented. Worst job market since the Great Depression. And since mid-March, you've had over 40 million Americans file unemployment claims. But notably, on the week ended May 16th, you saw continuing claims actually fall, which shows that some folks were going back to work, and that coincided with a lot of states reopening. So that's what I mean by less terrible. And that was very encouraging, and the market sort of ran with that. And then on the other side, you also saw very mixed news on the housing front. So new home sales for the month were actually positive month over month, when the consensus expectation was down 20%. So really surprising just about everyone. The median price of the average new home sold fell quite dramatically, but very encouraging to see, the housing market, at least the new housing market, showing some signs of life.
That's always a good sign. Let's talk a little bit about the stimulus side on the monetary and the fiscal side, not just here locally, but globally. We've seen a lot of action in May with respect to stimulus.
Yeah, globally, there's no doubt that the narrative now is money for nothing. Just governments increasing the amount of fiscal and monetary stimulus with absolutely no regard for any long-term implications or problems that might be created from a deficit situation. So a couple of key moments. In Europe, the European Commission passed an $823 billion rescue package consisting of grants and loans. which is great to see. It's a much more complicated fiscal and monetary situation over there, given that it's a European Union. So to see them pass something, that was very exciting, and the market rallied on that news. Japan continues to stimulate. They're trying to catch up with the US in terms of size of total stimulus. They passed a 1.1 trillion US dollar package. And then also China in their People's National Congress towards the end of the month. The communication from that Congress showed a lot of language suggesting that the 3-year deleveraging campaign that the Chinese government has been on has basically come to an end, and that they're willing to more aggressively stimulate their economy and grow credit, which is a very encouraging sign for industrials, materials, commodities, anything sensitive to economic growth.
And that's a big component to driving global growth. Let's talk about what the Fed's done specifically in this past year.
The Fed's done more of the same. So the Fed's balance sheet surpassed 7 trillion, which is actually a little slower than we expected. We thought by the end of May we could be close to 8 trillion, but now the call is 8 trillion by the end of the year, certainly. Another thing that we've seen is the Fed has finally started buying corporate bonds. So if you look at their balance sheet statistics, you're going to see corporate bonds show up now for the first time ever. Only about 35 billion worth, and the expectation is they could do about 10 times that over the course of the year. So that was definitely encouraging. And then a lot of discussion has been around, what next? What other tools does the Fed have? And we actually saw for a very brief period of time, the Fed funds futures market start to price in a negative federal funds rate in about January 2021. So negative interest rates on the short end is not something the Fed has done yet. There's a lot of ambiguity in the Federal Reserve Act whether or not the Fed can turn interest rates negative, but the market started to price in that the Fed will have to cut to negative rates sometime in early 2021.
Okay, let's turn our attention. It wasn't all bright and cheery in May. There's a lot of regulatory and compliance changes that have come forward that always generally the market does not like. So maybe walk us through some of those things and how they might impact us.
So domestically, a couple things happening. One, the Trump administration signed an executive order that would basically bring penalties towards large social media sites for censoring communication. Basically, the allegation is that they are censoring media and they're biased against conservatives. And this sort of all started when a couple of President Trump's tweets were flagged on Twitter for fact checking, saying that these tweets about voter fraud needed to be fact checked. So this executive order came about 2 days after that. So that has potential implications for large social media companies, which are some of the biggest stocks in U.S. equity indices. So that's very important if a narrative develops there. And then you also saw the Senate pass a bill that would basically require all foreign companies listed on U.S. exchanges to abide by U.S. securities laws and particularly accounting regulations. And so there are a number of large Chinese companies in particular that co-list on U.S. exchanges that do not follow U.S. accounting principles. And if they do not meet that standard, then they would be delisted. So you could potentially reduce these companies' ability to get US dollar funding, which is huge. So that's sort of what happened domestically. And then geopolitically, tensions definitely flaring up between China and Hong Kong, and then therefore between the US and China.
And those types of issues are generally more detrimental to the market, correct?
Definitely. A lot of the tensions, especially between the U.S. and China, are things that put a lid on the market for much of last year and brought a tremendous amount of volatility and fears of slower growth. And given how fragile the economic situation is right now, sort of the last thing the global economy needs is the two largest economies in the world going back and forth again on trade and sanctions.
Well, thanks, Mike. I appreciate your update, and we'll look forward to further updates as we move into the month of June.
Thank you.